It's the final hour for the US dollar, and the Federal Reserve has to do everything is possible to slow down the US dollar strength. However, Italy, on the other side of the Atlantic, is ready to finish up the EU with the mini-pot, the latest strategy by Italians to leave the euro slowly but surely. Let's take a look at what happened last week in our weekly FX recap. And also we're going to take a look at what's the state of the different US currencies hours before the FOMC data. Thank you for watching. This is Jose Ricardo Jaén. I'm the editor of the Prosperity Digest newsletter, and also I'm product specialist at Market Traders Daily. So we're going to take a look. Remember, please, I beg you to understand that we record all these videos for educational purposes only. They do not constitute an invitation for you to buy or sell any currencies. I do know, and our team knows, that you're using this in your best interest. But remember that we're not financial advisors, and all time the risk is on you. You know how much money you have, how much money you can risk, what's the equity in your trading account or investing account. You have to decide that. Please remember that past performance does not constitute future performance. Having said that, let's begin. So the first thing I want to share with you will be, let's take a look at this, is the latest report that Tyler published on Zero Hedge, the meet the mini-bot, Italy will break up the Eurozone. And there's no other way to say this. One way or another, the euro has to go below parity. And this is because there are so many challenges at the core of the European Union that we cannot be blind. We cannot keep just denying them. Okay, so this is the report. I will place this in the description of the video, also in the first comment of the video on YouTube, so you can have a look and go over this because it's alarming. It's alarming. Okay. Now, last week, the dollar by Wednesday, at the beginning of the week, the dollar was a little bit behind the wheel. It was not really doing well against the euro or the pound, and then suddenly all these currencies drop more than 100 pips. So that happened by mid-Wednesday. This is the last video from last week where Mullins is just gonna zoom in. You can see by Friday he was accumulated betting against the dollar. The only case that where he was making 24, he bet against the dollar on the USD versus JPY. US dollar versus Japanese yen, and then on the other ones he was favoring the dollar. This is the only one that he needed to bet because it's a risk play. But total accumulated by Friday was about 80 pips. The week before he took 90 pips home. So consistent strategy, consistent reporting produced by Mullins on a daily basis. He already published his video for the day on the US dollar versus Japanese yen. You can take a look. But the most important is that what is this for? What should you care? The basic thesis that Mullins applies is the fact that the market has memory. Don't confuse market memory with past performance. It's not the same. Market memory are levels where the market had specific decisions taking place. For example, this is a support in the Australian dollar around 70.15. Then the market went all the way up some point in June. We have that momentum in favor of the Australian dollar. It faded, and here we go. But if you just look at the charts, because that's all he does, you can see how he used this information to measure the fact that here we have support. Then once again we went down, we went up, but we couldn't break up the bearish trend line. And this is a level, this zone, the pink shaded area, it's a zone where the smart money made decisions, and this was in fact selling into resistance was a good strategy. Past market memory, basically we're saying if at some point this was a support, eventually it will be behaving as a resistance, and it did that. And about we have one, let me just take the pencil, this is the resistance, this is all the zone, and you have about here 70 to 100 pips total. And now we know it went all the way to check this area. Now, this area of support, we know that it was support again. We may think that if we buy here, our risk will be if it break below 64.65. And then our first target will be to go all the way back to 69.05. The challenge here is to understand what will happen with FOMC tomorrow or in the next couple hours. The thing with FOMC is that now we need the Federal Reserve to really support the economy. It doesn't mean that productivity will be higher, but in a very synthetic, artificial methodology, by either cutting interest rates, it will make less attractive the US dollar based on the carry trade, which is the difference between interest rates. Still, the dollar will have the upper hand because the interest rate is set at around, let's think about plus 250. If that's the case, it really doesn't matter. It's just an idea that it's 2. But then you have in Switzerland, you have minus 0.75, and the euro has been very low. And now you have you have the Reserve Bank of New Zealand. You have also the Reserve Bank of Australia going into cutting mode. They're going to start cutting rates. So what that does mean is that although the US dollar will be less attractive, still will be in a position of advantage. So in order to slow down the strength of the US dollar, the Federal Reserve will really have to push rates lower. And still, the number one currency that investors will look to fly when they are afraid of what happened in other places will be the US dollar. But in the short term, it can be a pullback, and that can be an advantage for currencies like the Australian dollar. This is just one example. I encourage you to go to our YouTube channel, Market Traders Daily, and you can go there and review previous other videos that Ross Mullins has published, and you can take a look at that. So if, for example, if Jerome Powell were to come out and be very dovish, which is difficult to see how, because the US economy is not doing bad, it's slowing down, but it's not in a chaotic mode. So we can see how the Australian dollar versus the US dollar will start pushing higher, and these will be your different targets to the upside. Let me just take this out. Let me have it one more time. Pencil. So one of the rules that I want to share with you, and I also wrote it in the Prosperity Digest newsletter. Ross Mullins has one basic idea. Every 20 pips, he moves his stop. And you may say you need to let the market breathe, but he's not here to let the market breathe with his money. So you have 68.65, and then this is your first target. This is your second target, third target, as long as you're long the Australian dollar. Every 20 pips, he will go break even. You can also set that with a trailing stop. It depends. But the idea is to be always protecting your capital. Low risk, high reward opportunities. That's where he's looking here. And every time that you're trading, you have to position yourself and make sure that you're measuring your risk. Okay? So that's the message. Okay, so that's the idea. So let me see, just take a look at this. I was explaining this is your, if you're looking at going long, this will be your first target, second target, third target. And I want to repeat this one more time to end the video. Ross Mullins goes with every time that you are 20 pips in profit, he moves the stop to break even. That's break even. You can break even your spread. Sometimes depends on the euro, your broker. It can be 1 pip, 2 pips. All depends. So he will go into break even, so he can no longer lose into the position. If you divide, for example, if you have one contract, you can go with 0.5, another position 0.5. So you can take profits at 20 pips, break even on the second position, and let it go. And this will be your different targets. Okay, so now let's wait to see what is going to happen with FOMC, how the market will react, and then we can assess exactly direction. Make sure you go to our YouTube channel, markettradersdaily.com, and review all the different daily publications from Ross Mullins. Thank you for watching, and have a good day.